Have you ever thought about this? Could you kind of supercharge your wealth by borrowing money to invest in the market? I mean, it's a really tempting idea, isn't it? Use someone else's money to make your own. But you know, it's also a strategy that is absolutely packed with risk. Okay, let's actually dive into this and see what the numbers have to say.
So we are going to tackle the big dilemma here, the whole idea of borrowing to invest. We're going to put this popular and, let's be honest, pretty controversial financial strategy right under the microscope.
And that really is the question, isn't it? Is this some kind of clever hack to get rich faster? Or is it a massive gamble that could leave you way worse off than when you started? The answer, as you're about to see, is definitely not a simple yes or no. So to really get to the bottom of this, we're going to take a single specific scenario. But here's the crucial part. We're going to look at it from two completely competing perspectives. We're going to use two different ways of measuring what success even means. And this is where things get really, really interesting.
Okay, first things first. We have to understand the financial stakes. Before we can even dream about potential profits, we need to be crystal clear on the cost of entry. So let's lay out the exact numbers for our scenario.
All right, here's our setup. Imagine someone borrows 20 lakh rupees. Simple enough. They've got 10 years to pay it all back, and the bank is charging them a 9% annual interest rate. These are the fixed numbers, the ground rules that both of our analyses are going to be working with.
And this visual, wow, it just perfectly illustrates the reality of that loan. You start with that 20 lakh loan, but over those 10 years of making monthly payments, the total amount you actually pay back to the bank is over 30 lakh rupees. That massive difference? Well, that's the price you pay for using their money.
And there is it. That's the magic number. Over 10 lakh rupees in pure interest costs. I want you to think of this as a hurdle, a huge hurdle. Your investment doesn't just need to make a little bit of money, it needs to make more than this 10 lakh rupees just for you to break even on the whole deal.
You know, our source material puts it perfectly. This isn't just some fee you pay on the side, it is the benchmark for success. Any investment you make with that borrowed 20 lakh has to clear this massive cost before a single rupee of profit actually lands in your pocket.
All right, so we've established the cost. Now let's look at this whole thing through our first lens, this perspective. Well, it's all about the final amount, the total size of your investment portfolio at the very end of that 10-year period. In finance, they call this the corpus.
Now, what's so interesting about how this is framed is that it gives you two distinct paths. Path 1 is borrow the 20 lakh and invest it all at once. That's a lump sum. Path 2 is forget the loan and instead just invest what would have been the monthly EMI into an SIP. The only question being asked here is which path gives you a bigger pile of money at the finish line. That's it.
So let's look at the data. If your investment earns, say, 7% a year, the SIP path, path 2, actually creates a bigger final corpus. Now, at 9%, which, remember, is the same as the loan rate, they're almost identical. But if your investment returns a healthy 10%, suddenly the lump sum path, the one using borrowed money, creates a larger final pot.
So, the verdict from this particular point of view is pretty clear, right? If your investment return is less than your loan interest rate, the SIP strategy comes out on top. If your return is higher, the lump sum strategy builds a bigger final pot of money. Seems simple enough.
So you might be thinking, okay, got it. SIP is the safer choice unless I'm really confident about high returns. But not so fast. Is the total size of your investment account really the only thing that matters? I mean, are we forgetting about that huge 30 lakh rupee loan we have to pay back? This brings us to our second lens.
And now we're going to see a completely different picture, our second perspective, our second lens. It ignores that big final number and focuses on one thing and one thing only, net profit. How much money are you actually left with after everything is said and done?
And I absolutely love this visual. It completely reframes the entire situation as a race. It's not about two separate paths anymore, no. It's about your investment returns racing against the relentless, ticking cost of the loan. The winner is whoever has more money in their pocket after the loan is completely paid off. So, let's just be crystal clear about what we are measuring now. We take the final value of the investment, that corpus we were just looking at, and then we subtract the entire 30+ lakh rupees we paid back to the bank. Whatever is left over, that is your true take-home profit.
And just look at this, the results are dramatically different. At a 10% return, the lump sum strategy generates over 23 lakh in net profit. The SIP, just over 11 lakh. That's less than half.
In fact, in every single scenario shown here, the net gain from borrowing and investing lump sum is significantly higher.
So what on earth is going on here? One analysis tells us the SIP is better at lower returns, but the other one says the lump sum is always more profitable. This brings us to probably the most important takeaway of this entire explainer.
Let's just put them side by side. Lens 1, the corpus view, it's just asking, how big is my account? And the winner there depends on the returns. But Lens 2, the net profit view, asks a totally different question. How much money did I actually make? And in that race, the lump sum strategy had a higher net profit in all of these scenarios because you simply had more money working for you for a longer period of time. So the big question is, which view is right? And here's the key. They both are. They're not wrong. They just answer different questions. And this really highlights a fundamental truth, not just in finance, but in life. The answer you get depends entirely on the question you ask. So when you boil it all down, this whole debate really comes down to three simple ideas. 1. This isn't really a battle between lump sum and SIP. 2. It is a direct contest between your investment returns and your loan costs. And 3. For this strategy to make any sense at all, your after-tax investment returns have to consistently, reliably be higher than your loan interest rate. That is the only way you can possibly win the race.
And that leaves us with a final question for you. Knowing that this whole strategy lives or dies on that razor-thin gap between your returns and your costs, and seeing how easily the winner can change just by framing the question differently, how would you define the win? What does a financial victory actually look like to you? Is it the biggest possible number in an account? Or is it the most actual profit in your pocket? Definitely something to think about.